Well, hello everyone, and welcome to your Daily 5 for February 24, 2022. I'm Joe Duarte from Joe Duarte and the MoneyOptions.com, author of Options Trading for Dummies, now in its 4th edition, the Everything Investing in Your 20s and 30s. If you like what you see here, consider a subscription, free trial to the Joe Duarte and the MoneyOptions.com website. Well, what a day we're having. As I record this presentation, there are news, obviously, that Russia has invaded Ukraine, and accordingly, the markets have crashed, which, of course, makes today's topic very, very timely. So here we are at the edge of chaos, literally. Today we're going to talk about my favorite indicator, 2.0, and that is the combination of the New York Stock Exchange Advanced Decline Line and the CBOE Volatility Index. So the goals of the presentation are to demystify why stock prices fall in downtrends, to pinpoint reliable trend analysis methods, and to improve price turning points and trading dynamics. To provide a roadmap that can be used in any market at any time is the ultimate goal. Of course, we want to have those sound trading principles for uncertain markets, and the key is to manage risk, prepare for the unexpected, and trade what you see. You don't want to fight the Fed, whatever that means at the moment, given the situation in Ukraine and the inflation and everything else that's going on. The key is to watch what the market does in response to news and events. You certainly don't want to fight market's momentum and denominate on the ground trends. And the key, again, is to focus on capital preservations while you build that shopping list for the next bull market. Again, trade in small lots and focus on your stocks relative to the market. If you got stocks that are holding up, there's no reason to sell them. Keep those time frames short. Never let a winner turn into a loser. Keep those tight sell stops. And the key, again, is to survive to fight another day. So, quick review of my favorite indicator, 1.0, the advanced decline line. Of course, the advanced decline line is a better market gauge than an index because it's purely factual. There's no distortion from big moves in Amazon.com or Netflix, and it helps us to filter out the noise. So again, quick review, complexity zone above the 200-day and 50-day moving average. Everything is good up here, market goes up. Chaos zone below the 200-day moving average and the 50-day moving average. Things aren't so good here. As you can see, the market broke below the 200-day moving average. New York Stock Exchange Advanced Decline continued to fall. And of course, the edge of chaos, that area between the 50 and the 200-day moving average, where the market coils and things happen from there. Now, quick review here also as well. RSI for the New York Stock Exchange Advanced Decline Line. You want to make sure that it's not oversold or overbought, as we see here, because when this thing gets oversold, especially now that the New York Stock Exchange Advanced Decline Line is outside the Bollinger Band, you could have some sort of bounce. So you want to be prepared for that. Okay, part 2, the CBOE Volatility Index. And so there's a simple concept here. See how this thing rises up and down. Well, what makes it go up and down? Well, when the VIX rises, it means there's heavy put volume. That means there's buying and selling, not just buying puts or selling puts, but both. That's what makes VIX go up. Okay, so the key to remember here is that lots of put action or action and put options, buying and selling, makes the VIX go up. And when that changes, the VIX goes down. Now, let's look at this in comparison. Let's look at VIX in comparison to the put-call ratio. Quick overview here, S&P 500. You can see lately it's been falling. You can see the highlight here. You can see the put-call ratio here kind of peaked a little bit, but mostly it's been going sideways. However, if we look at it closely here, the VIX has been in a short-term uptrend, and it has been a much better indicator of what the market has been wanting to do, which is to fall. So again, you don't want to ignore the put-call ratio. It can be a good indicator at major market bottoms especially, but you want to keep an eye on the VIX because that tells you that there's heavy action in put options. I'm going to tell you why that's important next. First thing though, who's in charge of the market? This is a very important question to answer. Of course, the market makers are in charge, and that means that we have algos, computer programs that trade constantly. All right. So market makers' primary directive is to stay in business. The number one goal is to manage risk. And so what they do is they hedge every trade, okay? And so when they hedge, it exaggerates options activity and influences the market trend. That may be a little confusing, but I'm going to work you through it. So their second goal is to make money. They make money on the spread of every trade. So when they stay in business, they can make money, and what they do is they survive to fight another day. So how does this all work? All right, let's review. The VIX measures put volume, buying and selling. So what happens in a bear market or in a market where people get fearful is that bearish traders buy puts. And as a result, the market makers have to sell puts to bearish traders. So when market makers sell puts, they are forced to hedge that bet by selling stock and selling stock index futures. Net effect is that you have rising put volume, again, buying from bears and selling from market makers. And again, the market maker hedging that selling of puts, which causes them to sell stock and sell stock index futures to hedge, is what causes falling stock prices. So let's put this all together. Here's the CBOE Volatility Index. Here's the New York Stock Exchange Advanced Decline Line. You can see this clearly. The VIX has been going up a lot lately, and that means a lot of put buying by bearish investors, a lot of put selling and hedging by market makers. The net effect is market goes down. Okay, so again, VIX means heavy put buying and heavy put selling, and the market goes down as a result. So let's recap. Bearish traders buy puts. Market makers sell puts to bearish traders. Market makers are hedging to stay in business, and they do that by selling stocks and stock index futures. The result, the VIX rises because put volume, buying and selling rises. Stock prices fall because of selling pressure from the market maker hedges, causing more put buying by bearish investors. So the net effect is a cascade of selling until put volume recedes. Use the New York Stock Exchange Advanced Decline Line, the CBOE Volatility Index. You can improve your trend analysis and your turning point analysis. That's all I have for today. I'm Joe Duarte from Joe Duarte and themoneyoptions.com, author of Options Trading for Dummies, the Everything Investing in your 20s and 30s. And if you like what you saw today, consider a free trial to Joe Duarte and themoneyoptions.com. Never forget, trading is uncertain. Be prepared.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.